Hello, everyone, and welcome to an episode of the newly started series of EPW Conversations with our editors. I am your host today, and my name is Divya Jyoti. Today, we have with us our very own editor, TK Arun, and we are going to discuss about the issue of declining value of the rupee. The conversation today will be primarily based on the editorial titled To Stabilize the Declining Rupee. And as the title itself suggests, we are going to delve deeper into the measures that could be taken to stabilize the value of rupee, which is declining and which is also undervalued. So, without wasting any further time of yours, my first question would be um, so, as we have seen that the exchange rate of the Indian rupee vis-a-vis dollar was at 90.26 in December 2025, which then declined up to 91.01 as of February 2026 and further to 95.70 on the 23rd of May 2026. Looking at this trend and, of course, the ongoing global events, the government of India has suggested few measures that could actually reduce the pressure on current account deficit. But the question to be asked is, why does it matter if the rupee goes down? Do you think that these measures are enough to reverse the decline of the rupee?
So let's begin with why it matters if the rupee value comes down. See, we import quite a lot of things from around the rest of the world, especially our
Hmm.
energy, our machinery, various kinds of inputs to our exports and domestic production. So all these things are denominated in dollars when you import them. So the lower the value of the rupee vis-a-vis each dollar, the price of the imported commodity goes up when the rupee depreciates. And that is the importance of the uh, rupees exchange rate. Now, if the price up, that feeds into all production lines and then feeds into inflation. And if the general price rise becomes entrenched, then the RBI will feel compelled to increase interest rates. So this in turn will increase the cost of capital and reduce economic activity. Then job generation will be hit and things will be very bad. Prices will be high, jobs will be fewer, economic activity
Yeah,
will come down, and so we don't want the rupee to decline too much.
yeah,
Now the question is, uh, you ask, is what the government has done in terms of the current account deficit measures, import of gold,
hmm,
asking people to travel less, be more austere in their lifestyle, are these
yeah,
sufficient? In my opinion, they are not. See, primarily these address things at the current account deficit, import and export of goods and
hmm,
services. In my opinion,
hmm,
the basic problem with the Indian economy, which is creating this current rupee problem, is not directly, although it might be seem to happen at the current account deficit level, it really stems from loss of growth momentum in the real economy. And unless that is addressed, just by playing around with the current account deficit or the import and export of things, nothing fundamentally will change.
hmm,
We need to revive basic economic growth momentum for us to get a hang on the rupee and for the rest of the problems that the economy suffers. This is the issue. Now, why does the current account deficit at the rupee level matter so much?
hmm,
See, we must understand one fundamental thing about the Indian economy. We typically run a current account deficit. See, unlike
yeah,
most other economies that have huge foreign exchange reserves, like
hmm,
China, Japan,
yeah,
Germany,
Japan.
South Korea, Taiwan, all these countries export far more than they import, which
Hmm,
means they have a trade surplus, and on the wider current account also they have a surplus. Whereas India always have had a current account deficit mostly, except for a
hmm,
few couple of years. Now,
hmm,
when you have a current account deficit, how do you still manage to accumulate foreign exchange reserves? When
hmm,
you have a
yeah,
current account deficit, you are actually depending upon external suppliers of capital to meet this deficit. So you are actually borrowing money to or creating liabilities to meet your gap between what you export and what you import. So how do
hmm,
you still have foreign exchange reserves? This is because India has more capital inflow than we actually absorb in the real economy. So capital inflow is the mainstay of India's foreign exchange reserves and the rupee stability. If these inflows of capital is impacted, then we have a problem with the value of the rupee, with foreign exchange reserves and everything else. And this has been hit in the recent past. Our foreign direct investment in the net has become barely positive. And some months it can even be negative because a lot of foreign investors have taken their money out. Some for good reasons, some
Hmm.
for not so good reasons. Some for reasons
Yeah.
related to their experience in the Indian economy, like Ford Motors, they left India because they couldn't sell their cars. Some because of external consolidation, like some cement companies, they decided to leave India, selling their holdings to Indian operators and
Hmm.
leave with their money because of consolidation at an international level. Nothing to do with India specifically. India is still a growing economy.
Hmm.
India needs cement. So there was no reason actually for them to leave India. Then there is some capital exiting because the Indian stock market is levels used to be very high, and they foreign investors saw an opportunity in making good on their past investments. They had made huge capital gains on the investments they had made, and they wanted to take out some of these capital gains and they took their capital out. So all these different ways, we have not been getting much capital, or rather, we have been seeing net outflows of capital or barely any capital inflows. Foreign portfolio investors, those who invest in the stock markets, they have been taking capital out in large amounts. Uh,
Hmm.
this year, this calendar year, so for the first 5 months and the last 6, 7 months of the last calendar year, they took money aggressively out. Now,
Hmm.
this is not again not entirely due to any problem in India. Uh, Thanks to Donald Trump's irrational policies, the US dollar itself is weakening,
Hmm.
and trust in the
Yeah. Yeah.
US dollar is weakening. And so,
Yeah.
the yield on US government treasuries has gone up. And the US
Hmm.
government treasuries has considered the safest uh, risk-free asset in the world, in the entire global
Hmm.
finance. See, that
Hmm.
itself is giving an investor something like 4.5, 5, 6%, depending on what tenures
Hmm.
bonds you buy. Then there
Hmm.
is less incentive for them to deploy their money outside the US in riskier places like India, unless the returns in India are superlative. Now, those returns in India have ceased to be superlative. One, because the rupee is declining. If the rupee is declining, then dollar returns of the same amount of rupees will come down, right? Suppose you make a 1,000 rupee return in India,
Hmm.
and the exchange rate is 100 rupee to a dollar, then that thousand
Hmm.
rupees of return will become $10, right? But suppose exchange rate changes to say 200 rupees, then that 1,000 rupees becomes only $5.
Hmm.
You understand? So if the rupee
Yeah.
depreciates, the dollar return comes down. Huh?
Hmm.
So I have said 100, 200 as an example, but the direction change
Hmm.
determines whether you actually increase your returns or decrease your returns. A declining exchange rate for the rupee means that your dollar returns come down. So you have to guard against that. There's a hedging cost. So, and on top of that, there are these tax matters which hadn't mattered till now, but now they
Hmm.
think that the capital gains tax that the foreign investors in India have to pay, all these add to the disincentive to stay on in India. So the Indian markets actually were very overpriced, say in 2024 and for half of 2025.
Hmm.
When the exchange rate in India goes down, the dollar returns on the Indian stock market comes down. And because of the increase in the yield on US treasuries, because the dollar has become more uncertain uh, commodity under policies of President Trump, uh, the return that bond investors in the US can get simply by investing in US treasuries is significantly higher than what it used to be even 2 years ago. So there is no reason for them to actually deploy their money outside their home country if they want to get
Hmm.
decent risk-free returns. And this combined with the consequence of war, uncertainty, and volatility in economic activity around the world, there is a
Hmm.
tendency for capital to leave markets where returns are not superlative. And India
Hmm.
returns haven't been superlative either in the real economy or thanks to depreciation at the, after converting it back into dollars in terms of dollar returns.
mm,
So portfolio investment is leaving, and direct investment has been on the in the net coming down. Also because Indians have been investing abroad. There is the
yeah,
ODM, overseas direct investment by Indians. That also has been going up.
mm,
So
yeah,
we have been seeing very little investment by the private sector within the domestic economy, even as some of them are actually investing abroad. So all
yeah,
this results in loss of economic dynamism within the domestic economy, and that
mm,
is the principal reason why the rupee is coming down, and not only because of current account related, trade related
mm.
problems.
Yeah. So I think you've raised a very crucial point that we have to focus on reviving our basic growth momentum, which is again very crucial at this point. My next question to you is a very basic question that a lot of students from non-economic backgrounds and people who do not understand, like who are not from economic background, would want to ask, which is what is the effective exchange rate, and what are real effective exchange rates and the nominal effective exchange rate?
Yeah. See, if India doesn't trade just with the US, we trade
Yeah,
with a variety of countries, right?
yeah,
So just by focusing on the exchange rate with the US, you'll be misled into thinking that the dollar has, I mean, the rupee has really depreciated so much, more than say 10% or so. However, since India engages with a number of other countries, if you look at the weighted value of our exchange rate is exchange with major trading partners. So the
hmm,
RBI actually takes into account six major currencies with
hmm,
which we trade. The US, the European Union, China, like that. We have six major exchange rates we take into account, and
hmm,
we weight these exchange rates with the trade we carry out with these economies or in these currencies, and the weighted average is the effective exchange rate. Now, the effective exchange rate can also be nominal or real, because uh, there is inflation in India, there is inflation in these trade partners, right? So, the effective inflation, if it is higher in India than in the trading partners, then that will tend to depreciate the rupee vis-a-vis that those economies. Because if the
hmm,
value of the rupee is going down in India itself, then naturally it will require more rupees to buy 1 unit of the currency where inflation is low, much lower. The prices are not going up. So,
yeah,
and these rates of inflation in different economies vary. So, we again look at the inflation in these different economies, and you uh, just if you don't factor in the inflation, you just calculate the exchange rate as it is in these the various different currencies, the various different economies, and take the average, weighting them by trade, you get the nominal effective exchange rate. But if you also take into account the differential rates of inflation in India and these economies, and deflate
yeah,
them for their price levels, change in price levels, then you get the real effective exchange rate, which means if you factor in the differential rates of inflation and take out their effect from the nominal exchange rate, then what is the
hmm,
actual decline? And this is the
yeah,
a better measure to what extent the rupee has actually declined. Now you will see that the decline in the nominal effective exchange rate is actually much higher than the decline in the real
hmm,
effective exchange rate.
yeah,
Because if you look at just the dollar index itself, under Trump,
yeah,
when his term started, the dollar index was something like 108 or 109. Now it is
hmm,
below 100.
hmm,
So he has
yeah,
managed to pull down the value of the dollar against six major other international currencies. Right.
hmm,
So, I mean, even after that, the rupee has fallen so much against the dollar. But
yes,
since we trade with all these other economies also, the real effective exchange rate after taking into account inflation has not been as bad as might
yeah,
seem by just looking at single currency variations
hmm,
vis-a-vis the European Union, China, or any other economies. But India right now is the worst performing currency in all of Asia
yeah,
vis-a-vis the dollar or other economies.
yeah. I think so. The nominal effective exchange rate is at 15%, and the real effective exchange rate is at 10%.
Decline, decline
Decline.
increase.
Yes, yes. Okay. So moving further, my next question to you would be, should the RBI intervene to stabilize the declining value of rupee? Should it raise rates and intervene in the currency markets?
So RBI can try to iron out the volatility in the exchange rates.
Hmm. Hmm. Hmm.
Support is moving wildly between, say, 95, 97, 93, 94, 96 and a half. If there's
Yeah.
fluctuation too much, the RBI can try to dampen
Hmm.
that. But the
Hmm.
RBI should not try to fix the value of the rupee at any particular target,
Hmm.
because this value is a reflection of more fundamental underlying processes which the RBI
Hmm.
cannot really try to influence. If we try to do
Yes.
that, then we greatly distort our basic economic incentives, allocation of capital, price signals, everything. So
Hmm.
RBI has been intervening to stabilize the value of the dollar or the rupee by
Yes.
selling dollars in the market. When the demand for dollars goes up sharply, then the
Hmm.
RBI runs down its reserves and supplies from the RBI's own kitty dollars that the market is demanding. If all the that demand is met by current supply from money dealers, then the rupee would
Hmm.
depreciate much more. But if the supply of
Hmm.
dollars is increased by the RBI itself selling some dollars, then of course the pressure on the rupee comes down. There is in economic theory something called impossible trilemma that central bankers have to uh, figure.
Hmm.
You cannot try to fix the exchange rate and have free capital mobility and have an independent monetary policy, all three of them together. Now, we want capital to come in. We need mobility of capital across borders. At the same time, uh, we don't want, we want to have the ability to set our own interest rates. That means
Yeah.
that we cannot set the exchange rate at any particular level. Something or the other must keep. We are allowed to, we are happy to allow the exchange rate to move according to fundamental pressures. We don't try to fix it, but we just iron out the volatility. However, when the RBA sells dollars in the market, what happens?
Hmm.
When the RBI comes and sells dollars, it is taking out
Yeah.
rupees from the system, right?
Right.
The RBI supplies dollars, then the RBI gets the rupees, right?
Yes.
So
Yes.
when rupees go from the market into the RBI, they sort of
Hmm.
disappear from circulation,
Hmm.
right?
Hmm. Hmm. Hmm.
So
Hmm.
that reduces liquidity and that puts upward pressure
Hmm.
on interest rates. So
Yeah.
such
Yes.
intervention is not costless.
Hmm.
So the same thing happens when the RBI uh, buys dollars. Suppose
Yeah.
uh, the RBI buys dollars, then
Yeah.
it injects rupees into the system, right? It increases the money
Yes.
supply.
Yes.
The
Yes.
increase the money supply can create
Hmm.
inflation.
Hmm.
So the RBI will tend to sell bonds to mop up some of these
Hmm.
rupees. With the RBI
Yeah.
mops up rupees
Hmm.
by selling bonds, the supply
Hmm.
of bonds in the market goes up, and that
Hmm.
tends to increase yields.
Yeah.
When the supply of bonds goes up, then the bond prices drop, right? When a
Hmm.
bond price drops, then the yield goes up, which means there
Yeah.
is again increase in interest rates. So there is no
Yeah.
costless intervention that the RBI can make in the foreign exchange market. It always
Okay.
carries a cost. So
Okay.
the RBI should only try to sort of smoothen out volatility, not try to fix the exchange rate at any particular level.
Okay. Hmm. Okay. Okay, another I think going back to the first question where you had also mentioned that it is very crucial at this point to revive the basic growth momentum, and I would like to now focus on what the editorial also states, that we have been seeing that there is a lot of foreign capital inflow in the Indian economy than it can actually absorb. So how can the policy makers address this, and what implications does it have on the current account deficit vis-a-vis the countries that you highlighted, like China and Japan, who have current account surpluses?
So, I mean, there is no economy which is actually roaring success right now. Surprisingly, the US is
Yeah.
growing not too badly, but however, they are facing
Hmm.
inflation pressures. Their labor participation rate is coming down. Fewer people are turning off work. All these issues are there.
Hmm.
India is still growing at a fairly reasonable rate compared to the rest of the world, but compared to the rate
Hmm.
India requires to generate jobs for these millions of people entering the workforce every year, we are not growing fast enough.
Hmm.
Now, the major problem in India for the last, say, 10, 12 years is that there isn't enough private sector investment happening. Private sectors, they find that capacity utilization of whatever they manufacture to sell to consumers, that capacity
Yeah.
utilization is stuck below 75%. That is 25% of capacity remaining underutilized. So, in such a
Hmm.
situation, why should they invest to increase capacity? Unless you see a great increase in demand, you will not add to capacity. So, demand has been flat.
Hmm.
Actually, only the premium segments of consumer goods or durables or even housing is growing. Only the premium segment. I mean, if you look at real estate ads that appear in the newspapers, every
Hmm.
flat is at least 2.5, 3 crore rupees. There is nothing which is selling for 50 lakh, 55 lakh. Even that is unaffordable for most Indians. But even for the middle class segments, uh,
Hmm.
the asking price is multiple crores of rupees. Nothing is
Hmm.
being offered in the affordable categories. This
Yeah.
shows a very serious uh, problem with demand. Low income demand has sort of stagnated, it's not growing, whereas some high end demand is growing. An economy the size of India cannot really grow, sustain growth purely on the basis of elite consumption. There must be demand from the mass of the people, and you must have purchasing power in their hands. Then can this happen. Additionally, we are squeezing demand by stupid policy. Every single additional major investment is happening in existing towns. So, in a, so if you today's newspaper says Amazon is buying up some 10 acres of land in Thane, in Bombay.
Yeah.
So this is
Yeah.
further increasing real estate prices in Bombay, which
Hmm.
means people will be forced to spend more money on rent. They'll be forced to spend more money on buying new homes, and rather than
Yes.
buy the things they actually want to spend on leisure or necessities or whatever. So discretionary spending is being squeezed by uh, improper urbanization. Suppose you had new towns where data centers would come up, and more workers could find fresh residences where the rents would be cheaper, facilities would be far more less pressure, roads would be freer for traffic. Suppose you had this kind of an ideal situation, then you will find that
Hmm.
people have more spending money in their hands to spend. Now we are squeezing the incomes of the mass of the people. Only the elite have money to spend, and even these people are being forced to spend much more than was required on things like housing, on things like very premium items of expenditure. Now, unless private investment goes up, the economy really cannot grow. It cannot grow purely on the strength of government expenditure. And India ceased to see private investment basically because private investment in infrastructure has dried up. Unless you can revive large scale public private partnership in infrastructure, you will not see private sector going up. The government did announce its intention to revive PPP, public private partnership in infrastructure, in the
Yeah.
budget
Yeah.
uh, last year, not this year, even last year.
Yes.
But no
Last year.
policies were announced because PPP requires sector specific policy to make them intelligent, to make them actually work. That hasn't happened. So, in the absence of functional policy, workable policy, private sector is not investing in infrastructure, and the private sector is not really increasing its own production capacity because there is no great demand on the horizon. So, why will they invest in either their own capacity, increasing their own capacity, or in infrastructure because there is no policy? So, these are the
Yeah.
things that the government needs to focus their attention on. Or PPP, so that private sector will invest in infrastructure. We need lots of infrastructure, like for example, new towns, or new
Yes.
railroads, new roads.
Hmm.
So
Hmm.
we need all that. If you create new functional policy for these sectors, and which will allow the private sector to invest in these sectors, that will revive the growth momentum. And once that growth momentum revives, you will find foreign capital flowing in, both as direct investment (FDI) and portfolio
Yes.
investment to take benefit in the revival in the stock markets. So this is the real solution, not trying to curb imports, uh, and
Hmm.
curb expenditure and call for austerity.
Yeah. Okay. And my last question to you would be, sir, like, what should the government do to strengthen the rupee right now?
So the government has no short-term fix for strengthening the rupee. Uh,
Hmm.
Of course, government has in the past tried to mobilize NRI deposits. You can always
Hmm.
call upon your huge diaspora, which sends you the world's largest amount of remittances every year. You
Hmm.
can ask them
Hmm.
to loan us some of the capital and take them as deposits. This inflow of capital will actually strengthen the rupee in the short run. But there's only a short
Hmm.
term fix. Unless you fix
Yes.
the fundamental dynamics, you will not really uh, get the rupee to stabilize. Right now, also, let us understand it's because of the extremely high prices of energy, fertilizer, all
Hmm.
these things, which
Hmm.
is
Yeah.
creating the additional pressure on the rupee. So, if
Hmm.
the war gets over, then things will
Hmm.
improve.
Yes.
And the Hormuz Strait opens up, and once again, tankers of oil and tankers of LNG start moving through these straits and into the world market. Prices will drop,
Hmm.
and that will ease the pressure on the rupee to depreciate.
Yeah. Yeah. Thank you so much, sir. I think the key point to take away from this today's conversation would be reviving the basic growth momentum. And I think all the policymakers and the government should at least focus on that. Like with this, we would like to conclude our session today. And I hope all and request all the viewers to subscribe to EPW. And please tune in back again once we are back with the new episode. Thank you so much for joining us today. Thank you.